tell us a little about your portfolio. Why so few names? Obviously there has been some rumors of the performance, up 6% for the first quarter. I know you can't say that's accurate or not accurate. With most of your portfolio up double digits, one down to double digits, which we'll talk about. But give us just a take on why so few names, and
so for a bunch of reasons. I mean, I've always had the view that why not own the best 10 or 11 investments as opposed to ideas 12 through 25 or 12 through 100, which is more typical. And I think there are very few great investments at any one time. So the ability to concentrate is an enormously valuable asset of a strategy. The problem with it is it leads to bumpier returns, and it leads to more attention on mistakes or things that aren't going well. I don't know a portfolio manager that doesn't have a stock that's down in his portfolio, right? But if you want to make high rates of return over a long period of time, it's hard to do that being very diversified. I mean, if you look through the Forbes 400, wealthiest people in the world, most of them made their fortune in one business or a portfolio of 2 businesses. Very few made it in a portfolio of 100.
Do you have hard lines within your portfolio? You like to have 5%, 10% exposure to precious metals or physical gold or silver?
No, I don't have any hard lines like that. I mean, I guess if I were a trust department or a major bank, I would have hard lines like that. Somebody would say, okay, everybody 10% in gold or whatever, 8% in technology. I don't invest that way. I'm too lazy or too simple or something. I try to find the good opportunities, whatever they are, and try to focus. Diversification is not a way to get rich. Diversification is a way that brokers can protect themselves if you want to sue them. But if you really want to, Henry Ford didn't diversify. He concentrated and focused. So if you want to get rich, figure out the best basket and put all your eggs in that basket. You've got to get the right basket, Jay, or you go bankrupt pretty quickly. But that's the way to succeed as an investor. It's also a way to go bankrupt very quickly if you get it wrong.
I don't believe in diversification at all. I would own one stock if I could find one great stock. Diversification is a big mistake. I call it diversification. You buy this thing that might balance this other thing and they both go down. So I don't believe in diversification at all. I would own one stock. But what I do believe in is if I find 10 good stories, they're all equally attractive, I buy all 10. And I wait to see them unfold. It's like watching 10 poker games. 10 games of stud poker. You watch the cards turn over, story 3 gets better, story 6 slips, story 7 stays the same but it goes up 50%, so you sell 7 and buy 2. That's all I do. So if they're equally attractive, I buy all 10. Then gradually some story says, oh my God, this is getting better and better, and guess what? The stock just went down. So you keep watching 10 stories and magically, because of that rule of stocks going up and down a lot, then you load up. You really take a big advantage. So that either happens because something happens to the company or the market goes down and all stocks go down.
I'm from Scottsdale, Arizona, and I'm very interested in your policies on diversification and also how you concentrate your investments. And I've studied your annual reports going back a good number of years, and there's been years where you had a lot of stocks in your marketable equitable securities portfolio, and there was one year where you only had 3 in 1987. So I have 2 questions. Given the number of stocks that you have in the portfolio now, what does that imply about your view of the market in terms of, is it fairly valued, that kind of idea? And second of all, it seems that whenever you take a new investment, you never take less than about 5% and never more than about 10% of the total portfolio with that new position. And I wanted to see if I'm correct about that.
Yeah, well, on the second point, that really isn't correct. We have positions which you don't even see because we only list. And obviously, those are all smaller positions. Sometimes that's because they're smaller companies and we couldn't get that much money in. Sometimes it's because the prices moved up after we bought them. And sometimes it's because we may be selling the position down even. But so we have there's nothing magic. We like to put a lot of money in things that we feel strongly about. And that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, if all it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own one stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is you don't need it. I mean, if you have a really wonderful business is very well protected against the vicissitudes of the economy over time and competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses, and they'll be safer, incidentally. I mean, there is less risk in owning 3 easy to identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that.
Talk about your investment philosophy and why you got those types of results. How did you do it?
Well, my idea of risk control is a little non-conventional. I like putting all my eggs in one basket and then watching the basket very carefully. I think, I don't know what they teach at Marshall, but at most business schools they teach, I think, a lot of nonsense called risk-adjusted return and diversification. As a money manager, if you look at a normal portfolio, most people will make 70-80% of money that year on 2 or 3 ideas, even though they'll have 30 or 40 things in their portfolio. My concept was to put into those 2 or 3 ideas that I had the most conviction in. I was also lucky to travel across asset classes, so I traded commodities, currencies, bonds, and equities, and it gave me the discipline. If I didn't have a good idea in equities, I was happy to have no equities, or the same thing with bonds. So when you have a quiver with a bunch of arrows in it, you can usually find something to put a lot of money into. The only other thing I'd say is too many investors look at the present. The present is already in the price. You have to think out of the box and sort of visualize 18 to 24 months from now what the world is going to be and what securities might trade at. What a company's been earning is ridiculous. It doesn't mean anything. What you have to look at is what people think, what a company's earning, what people think it's going to earn, and if you can see something 2 years it's going to be entirely different than the conventional wisdom, that's how you make money. My first boss used to say the obvious is obviously wrong. If you invest in conventional wisdom, you're going to lose your butt.
They all emphasize the importance of concentrating investments on a few high-quality assets rather than diversifying across many average investments. The idea is to identify and focus on the best opportunities rather than spreading resources thin. Warren Buffett argues against diversification, considering it a protection against ignorance and stating that it makes little sense for those who can analyze and value businesses effectively. And that's the key. Having an edge in identifying good investment opportunities with fundamental analysis will allow you to concentrate on a few exceptional companies resilient against economic fluctuations and competition. If you acknowledge that you need more time to develop those skills, you should be diversified. Hit the subscribe button to catch our next episode, where we discuss diversifying your investment portfolio as a hedge fund manager using factor investment strategy. Stanley Druckenmiller's risk control involves closely monitoring the chosen investments. It emphasizes the importance of looking beyond the present and envisioning the future state of the world to make profitable investment decisions. He encourages thinking differently and going against conventional wisdom, because following the obvious or popular choices is a path to potential loss. Thanks for watching. If you found the information presented in this video to be useful, actionable, and informative, we would greatly appreciate having you back for our next episode, which will guide you on how to use factor investing in your portfolio. See you next week.